Welcome everyone to today's webinar, Implications of COVID-19 on P&C Insurers. This is brought to you by Johnson Lambert. I'm Kim Mobley, partner with Johnson Lambert, and before I introduce my colleagues, I need to cover a few administrative items with you. First, you can download a copy of today's presentation from the resources window. If you experience any technical difficulty during the webinar, please click the help icon. To engage with our presenters, please submit your questions in the Q&A window. We will do our best to answer as many of your questions during or at the end of today's session. For those interested in receiving Cte Cre Credit for participating in our webinar, you will need to go to the certificate icon. You can launch the certificate window to monitor your progress towards earning your certificate. Once you've met the criteria, you will see a certificate image appear in the certificate window. Click on this image to download your certificate. The only way to obtain your Cte Cre Credit is by downloading it through this platform. Credit is not available for group viewing. Johnson Lambert uses polling questions for credit verification purposes. So to receive your one Cte or Cre credit for today's session, you need to be present for 50 minutes and answer at a minimum of 3 polling questions. We're all trying to minimize our background noises and working from home, so please be patient with us if you hear any unnecessary or additional noises. These two presenters may not need any introduction, but I want to go ahead and give a brief intro of John and Reed. John Andre is Managing Director in the Property Casualty Ratings Division of AM Best Rating Services. In his over 30-year career with AM Best, John has been involved with the analysis of a wide variety of insurers in more than 90 countries. John manages U.S.-based teams of analysts that follow regional U.S. insurers, Caribbean-based carriers, medical professional liability insurers, captives, and specialty writers. Reed Davis is Regional President of McGriff, leading commercial insurance and employee benefits brokers. Reed is responsible for the operations of the Georgia region and offices in Colorado, Minnesota, Oregon, and Washington. Reed is the real estate and hospitality practice leader for McGriff, and he specializes in complex risk financing transactions, real estate, private equity, manufacturing, and healthcare. Their bios are impressive and can be found in the resources section of your screen, along with reports from AM Best. These reports include Best commentary on legislation to nullify the BI exclusions, Best market segment outlook for U.S. medical professional liability, and a special report on stress testing rated companies for COVID-19 that was released on Monday. Before we begin, I want to say our thoughts are with the first responders, healthcare workers, patients, and their families who are fighting the virus. This pandemic is impacting all of us personally and professionally. With shelter in place, many of us are working from home while managing virtual school for our kids, keeping our teams productive, morale up, and trying to take walks whenever we can. We're seeing unprecedented unemployment, with approximately 1 in every 6 workers laid off in a month's time. This situation is fluid, and we're learning more information every day. The effects are evolving from changes the way we live, work, impacts on our economy, and legal developments. Our agenda is going to address the complex topics of coverage issues, legislative developments, reinsurance impact, and the potential long-term impacts on our industry. All right, to start checking the boxes for our CP, let's get a polling question out of the way. The first one, has the pandemic impacted the way you do business? 1, significantly impacted, 2, somewhat impacted, 3, no impact, and 4, not applicable or for use for Johnson Lambert employees. As a reminder, to receive CP or CRE credit, you must answer a minimum of 3 polling questions. So please remember to push the submit button. All right, we'll give it just a second, and then I'll go ahead and close the poll. All right, for the results, John and Reed, do our polling results align with what you're seeing from companies you're working with? We've got somewhat impacted.
This is Reed. Thanks for including us. When I look at this, I would have thought it would have been more highly rated or tilted toward the significantly impacted the way we do business. But I guess there's a wide array of companies that were already embracing work from home and certain other things that were going on, and supply chain controls that we've seen with a lot of our customers getting disrupted.
This is John. The first thing, mid-March or so, when this thing really started breaking the other way, our immediate, as a rating agency, our immediate reaction, of course, was to survey the companies we deal with. And so globally, 1,400 rating units were surveyed in pretty high-level questions, and a lot of it was about business continuity, any changes to internal stress testing, adjustments, if they had any yet, most didn't, to their 2020 projections, and updates to their product assumptions and any sensitivity adjustments. And as we garnered the results, we were universally very pleased with the response, particularly about continuity. And that's probably the key part of this question. And now, I have to say that there has been connectivity problems here and there, and I've had them on occasion, but certainly the companies are pretty operational. I think a lot of URM work the past number of years in the insurance industry as prep companies for events. Maybe they weren't thinking of pandemic, maybe they're thinking of a major weather event or what have you, to keep people out of an office for a week or two at a time, and now we're into 8 or 9 or 10. But albeit, it was still good planning. And, lastly, just from what we all do at AM Best, we've been fully functioning rating companies remotely, releasing research, releasing news. We're keeping our role going. So.
Yeah, and to piggyback on that, John, I think we've seen most of our clients and a lot of the questions around the way they do business currently, and the processes may not have changed, but how they're having to do it and the communication skills that are necessary to operate in this environment have been tested and stressed. And then a lot of clients that are in customer service business and the sales side is trying to that has an outside sales force. That part is significantly being impacted from people that can't travel or the things that they want to do. And so I think the current business environment seems to be operating well in a lot of industries, but just how they change their dynamic and obtaining new business seems maybe one of the larger questions.
Good point. Yep.
Those are things we're seeing across the board. Now we'll dig into the coverage challenges. Let's start off with the big one that's out there, business interruption. Reed, as you're working to develop risk management strategies for your clients, one of the top items for property coverage is business interruption. Each week we're seeing new states with proposed legislation. What do you see as the latest developments in this area?
I think everybody. There's probably a lot of folks on this call, and throughout this is the gorilla in the room, so to speak. And how do we address it? A couple of statistics that just came out this morning. We get updates every day. Currently, there are over 250 coverage lawsuits that have been filed. That's up from I was on a webinar last Thursday, and there was only it had just crested at 200, so there's over 250, but there's over 1,300 cases relating to COVID-19, CV-19, coronavirus, whatever we want to call it, that have been filed across all different aspects of coverage. So we'll talk more about that. You had 38 states that have presented or are contemplating various actions related to coverage structures, cancellations, premium forbearance, those kind of things that are going on. There's 16 different legislatures that have pushed forward some form of affirmation for BI and how they redefine BI that's going through it. And I'm sure more and more of them are going to be pressured as they come back into session to do certain things. The biggest one being on whether or not that the definition where everybody's heard about and the challenges coming through the physical damage, the two things that we're arguing over coverage in all these suits. One is the definition of physical damage, which all the insurance companies are saying has to be from a trigger to trigger cause, and then the other one is the governmental authority. The physical damage reformation, especially if you read what just came out of the Pennsylvania Supreme Court, which is the first one to actually give a ruling that broadens it, even though it has not been adjudicated in court yet, would change the trigger from just the fact that there is an occurrence versus having to prove that there's physical damage in order to affect a claim. That's going to be really interesting to follow to see how many other states adapt that. in the wording and then how the carriers respond. The other parts are, there's been a number, obviously, of funding structures and discussions around for various states, small business, and the different things that go on with how they're going to fund a BI-type product or program. You know, the federal courts we've seen Maxine Waters and the folks in California that are pushing through what is the Pandemic Risk Insurance Act. That's a future event issue, and that's in the federal court. So in the states, they're looking at how do they do this and how do they do it for small businesses, because obviously insurance is a state-regulated product with some federal oversight, and how are they going to do it? Every one of them that they come back to all talks about some type of assessment or tax, so you can trust that there'll be some additional costs that are layered into that. We believe, you know, as an industry, I think if you talk to everybody and if you look at how what they're posting on their balance sheets, they believe that there will be something that comes through. They'll be forcing them to pay for some of these claims in certain ways. There will be a significant amount of legal expense that's going to be on both sides to defend their position or to try to make sure that the claims, that they actually have their voice so that they don't, because, they will tell you this was not something that was contemplated in their models. We'll talk about that later on in this webinar and what that really means to price and investment. And then I think the last thing, there's two things I think that are important, not the last thing, but one of them, I think if you really think about the insurance industry as a whole, if there is going to be some type of federal stimulus or backstop or payment, it's not going to be handled the way as $1,200 an employee, here it is, here's your share. It's going to be, okay, we're going to redefine the wording, we're going to create this fund, now we're going to have to prove a claim. The insurance industry is geared and set up to process claims, but you're still going to have to prove the claim to get paid. And so I think the next challenge, it's not even discussed, and I think it's being kicked around a lot, is, okay, I had a CV loss, I was shut down by governmental authority, all those things are triggered. Now, how much of that claim is because I was impacted versus how much of it was my supply chain, my customers, the people that couldn't get out? What is my true loss? And was an attractive issue on the contingent related issues that really drive your business. So there's still a long way to go. I guess in the short discussion, there's a long way to go till we get to a point where business interruption is a covered event or not a covered event, just through the courts, the legislations, and then how you even prove the claim.
Great point. John. Oh, yeah.
Yep. Sorry.
Go ahead.
Yeah,
I was going to say AMS released the studies.
Right. Just on May 5th, my colleagues put out a study just looking at the impact. And as everyone knows, we rate a wide array of companies, from national and international writers and to regional and super regionals, and then more regional and maybe more local 2 and 3 state writers. And frankly, the bigger companies have broader spread of risk, broader diversification, and the smaller, more niche companies certainly are focused, and very strong companies are certainly in their own way, but a lot of them are emphasizing certain of these coverages, and frankly, in a lot of the more impacted states by COVID. So, we did a study, and it's, again, you can all get it off the website, and what we did is we looked to see what the impact would be on the capitalization of the industry. So we assumed a total economic losses of small business with fewer 100 employees at $294 billion a month owing to BI. From this estimate, we saw the impact of the legislation from anywhere from $150 to $200 billion a month. And so we estimated how much surplus would be exposed. So the U.S. statutory surplus of $874 billion, we took the assumption that $633 billion was in play for these commercial type coverages, CMP and BOP. So therefore, if you take $150 to $200 million a month on that base, it looks like an after-tax loss of anywhere from 37% to 50%. So our BACAR assessment, which is our capital model, would, and certainly a very integral part of our rating analysis, would take a very substantial hit if indeed this were to play out the way that people have been speaking about it. Certainly, it would result in, it would result certainly in the underwriting impact. There would be other problems too: underwriting impact, the equity valuation, deterioration of credit conditions. So, all things considered, though, it will have a major impact on a number of ratings, particularly those who are more narrowly focused. And frankly, it would have to be reconsidering our rating analysis, contract viability in the future, which is something we've always took for, we took to believe that indeed a contract was a contract. And to look back on something retrospectively, it would have a detrimental impact, frankly, on the insurance industry and as a result, certainly on the economy. So, and the piece can do it a lot better justice than I just did in 2 minutes, but it'd be a very major issue if this thing were to play out like the way it's been discussed in certain circles. So, thanks, Kim.
I definitely agree. Let's move to environmental insurance. This is one of the products that may pay for COVID-19 related losses, but the coverage provided by each policy is unique and has to be evaluated on a case-by-case basis. Reed, how are you seeing the coverage vary in your experience?
That's a great question, and it's starting to get a lot of press because of some claims that have come forward. But there's I'll use the word "some" quite a bit in this discussion because there's so many different various coverage forms in the environmental side that have been developed for construction, for some real estate, for true environmental operations, and some that just happen to buy it for compliance and other reasons. So, there's some that affirm coverage. There are some policies that do affirm coverage for communicable disease, bacteria, and virus, and whether or not it's a cleanup, and some policies have an extension for business interruption associated with these aspects of the business, and if that is defined under the term as a pollutant, what's the impact of those in the area, and what are the triggers around these policies that may also vary. And how will we get that? Some have a broader definition, and you'll hear the term a lot now because it came up recently in microbial matter. And what does that mean? And does that include viruses and other things? So you have to look at the definitions that you see there. And then there are some policies that have very specific exclusions around this, and those will be harder to challenge as it relates to where it goes through. The other part still comes with the combination and combining the coverage between what's a cleanup, what's the duration of cleanup, and what is truly causing a business interruption event, and how long does that take place. And then there's some, because in some of these policies where there's not the same trigger under a property policy for governmental authority shutdown or whatever it may be, there is still certain aspects that could be mandated regarding government cleanups. We haven't seen that yet, but there are provisions and policies that go forward that relate to things that have to be done for sanitizing the facility and things that you have to do that could layer over into an extended period of time for closure. The one area that I have not seen any discussion around yet that I'm curious to see as it comes through, as people start to reopen businesses, we're going to talk more about it in GL, but a lot of these environmental policies also have third-party liability coverage built in as well to some sublimit. Are these going to be considered if the pollutant that was not cleaned or whatever it's exposed? Is that going to be owned by the business, or is that going to be a natural hazard that comes through because it's inside of your four walls when they come in, if they claim that that's been a loss? But I've not seen anything on that yet. But I'm sure the plaintiff bar will get pretty creative when they start finding avenues to go down. I hope that helps.
Definitely. John, let's move to workers' compensation. I understand you're watching developments related to workers' compensation very closely. And we saw at the end of April, a state commission in Illinois voted to repeal a new rule that would have made workers' compensation benefits available to essential employees who contracted COVID-19 without having to prove the illness was contracted at the workplace. How are you seeing insurers navigate the determination of whether a claim is an employee benefit, health insurance, or workers' compensation claim?
Yeah, and as Reed said to one of his responses a few minutes ago, the fact that it's so state-specific, certainly in what we're dealing with, we've seen actions in other states as well. So I'll speak to one of those in a second. But just for some background, again, we've run a gamut in terms of national riders and local and state and specialty, and certainly a lot in the workers' comp space. And the sector is super well capitalized, certainly year-end 19, and even through the first quarter of 20, coming off a couple of years of very strong underwriting profitability. In fact, prior to COVID-19, we were stable on the workers' comp sector. Our rating outlook was stable prior, and we only flipped it towards the end of March, early April, And we were worried about the many socioeconomic issues and the impact of that on comp. Just last week, the NCCI had their annual issues meeting. Coming off of 2 years of private market below 90 combined with a $10 billion loss reserve. So certainly the comp writers are well capitalized and coming off of some strong performance. And frankly, for a few years now, had been carrying that whole commercial line segment. Comp had really been helping to carry the whole segment. But now the unknowns certainly come in, and certainly top line's getting impacted since it's payroll-based. Certainly when there's crises in the past, local economic crises in the past, maybe there's less fraud, there's less claims activity just naturally because of people who are working want to keep their jobs per se, right? But then now of course you get the whole COVID overlay that we're learning about, and certainly the issue popped up in California back in April. The WCIRB put out a study on the presumptive clause in California on the cost if presumptive costs of COVID-related for healthcare workers, firefighters, EMS, rescue workers, frontline officers, and so on and so forth, other critical infrastructure employees. And at the time, they came up with a really wide range of $2.2 billion of 33 to 33.6 billion of claims, with a mid-range estimate of 11.2 billion, which is 60% of the cost of the total workers' comp system prior to the impact. Now, since then, Governor Newsom put out an announcement, I think May 6th or so, that he took a little off of it, but he made it rebuttable. So it wasn't presumptive. You'd have to prove it with a lot more protections on it, perhaps in favor of the industry. The WCIRB hasn't put out an estimate to their new number yet. Regardless, though, that it's still certainly going to be a number, and nothing that was expected prior to the event. And I guess the reason really to speak about California is that it's certainly the largest comp market, probably the largest market we have anyway, but certainly the largest comp market. And you may see some similar actions in other states again, because it's very fragmented the way that the line is regulated. So it all gets down to whether the incident occurred at work or not. So long story short, though, fortunately, the industry is well capitalized going into it. Whether they will be enough for how this plays out or not, it's hard to say. Certainly, it's something that we're tracking, and like I said, it's going to vary state to state, but we're certainly keen to follow the California situation further.
Yeah, and John, today there was or last night, I guess, in Pennsylvania, the Senate bill that passed and they expected to go to the governor for ratification, was that any essential employee that's been deemed or has been exposed or affected by CV will be considered on-duty time while they're off-duty. So the indemnity benefits, that was interesting to see how that wording was put forward in Pennsylvania as well.
John, AM Best has the market segment outlook on U.S. medical professional liability that was recently published and is in the resources section. There was a negative outlook for 2020. Can you tell us about those drivers?
Yeah, gosh, I'm full of negatives, but the class has been problematic for a few years now. And again, pre-COVID, we had a negative outlook on the sector. And then that I should qualify this. Negative outlook doesn't mean that we're going to downgrade all the companies in the sector by any means. I mean, it just says that, that certainly the challenges are negative, and it takes a strong company to overcome those challenges. We're focusing in the sector to either maintain their ratings or perhaps, improve their outlook or what have you. So it's kind of just speaking about the headwinds that the companies face. And certainly we saw med-mal pre and post-event as many. Depressed demand, diminishing reserve redundancies, concerns regarding rate adequacy, rising loss costs, social inflation, the big buzzword pre-COVID. Social inflation was all everybody was talking about. And certainly in spades with NPL, litigation funding, increased jury awards were issues. Now we're seeing post-COVID patient hours of work. We're seeing premium rebates on medical mal in certain states, California for sure, since with the premise that the doctors are less exposed to perhaps doing less work because standard care, standard office visits are curtailed during the event. The big issue on the table, and I think we're seeing some positives there, is the doctors and healthcare specialists operating outside their expertise through the event, and the strain on hospitals, the shortage of medical equipment, and particularly with certain states where the coronavirus is pretty heavy, particularly in the Northeast where the coronavirus has had certainly a big impact. But we figure that, and the industry is keen that the Good Samaritan laws in all 50 states are providing immunity to licensed physicians acting in good faith to provide gratuitous care in the case of an accident. And I think that'll overlay certainly on these good people responding to the issues of the past couple months. New York came out in early April immunizing physicians and other healthcare workers. Mid-April, Massachusetts come out with similar orders are in process in New Jersey and Michigan. Recently, federal level, Senate Majority Leader Mitch McConnell, while they haven't done it yet, though, he has spoken out in favor of it, and the House is working on a bipartisan group is working on a health coalition on liability and access bill, which will give national protections on those people on the front line. So I think a lot of that concern we had back in March when we changed the outlook maybe is getting corralled now. That concern about the unknown about these good people working throughout this issue. I guess there's also thought, too, that the lawyers are less likely to take up lawsuits against healthcare professionals who are volunteering maybe because of the sentiment around the great work that we're all doing. So that might slow down. Frankly, I think we're hearing from the comp carriers there's been less action only because the courts are closed. So you're seeing that's from standard malpractice claims. But I think a lot of these new claims will be slowed down because there's some good sentiment behind what's going on all across the country. So we again, state to state, a lot of medical mal companies are certainly state specific or state heavy and regional carriers, and it's something that our teams are continuing to have conversations with. Thank you.
Definitely. Reed, as states open back up, what do you see as the challenges to prove negligence for general liability policies, and what's the implication on pricing and renewals?
Great question, and John used one of the terms just a second ago that I was going to use, which social inflation is being driven by a lot of things, and not to get into our terms, but a lot of it's just simply the growth in the number of claims, and somebody's always got to be at fault or blame when something happens. So, I think that there's a couple of things to be pointed at right away. We've already seen in the Walmart claim in Illinois, and, you can pick these big states that are big urbanized states that tend to influence things that go on around, and Illinois is one of those states. And the Walmart claim simply was that there was an employee that contracted COVID, passed away, and the family has already filed suit against Walmart for not providing a safe and work environment, where we've seen that as well now with a couple of other states where claims are being put around the class action. There's been a big push against some of the larger employers, and Costco's facing it in Washington as well with some of the environmental things that they've done and not putting their employee safety first, which you would think would be a workers' compensation, but they're bringing it over into the GL side as well, depending on what the legalities are in those states. The OL&T exposed businesses, i.e. the retail businesses, the hospitality business, the people where we go visit as people, are being heavily scrutinized in the marketplace under renewals right now. All of them are coming to, and every submission that we get or questions are coming back is everybody wants to see the operational plan, the things that they're doing in place to determine and how well thought out they are and how they measure. It's not just what they can do, because everybody can go online to the CDC or some of the other industry focus groups. We've put one out as an organization to help our clients, guide them through what are requirements around reopening their businesses, and everyone has a little bit different set of circumstances, but what they really want to look at is how are you measuring, how are you adhering to it, because as you know, and when you get into class action suits or any lawsuit, when there's liability being proven, that's the first thing they're going to look at is what did you do, how do we know that you did it, and how did you follow up on it. So those are actually, to some degree, those scorecards may be creating weapons to be used against them in certain cases if they fall into the hands of the plaintiff bar. Price increases and exclusions, we are seeing as we were already, it was hard to measure at first because we were already in a very difficult marketplace. I think most buyers of insurance realize, and John mentioned it, other than workers' compensation, which now we're going to start running into some workers' compensation challenges because costs were going up across every line of coverage, especially in the liability and on the excess liability placements. And so the fear of what could happen with class action issues, especially around those that have a lot of consumer or general population, are going to continue to go up and continue to restrict. We have seen specific exclusions that have been pushed forth. There already was an ISO exclusion that could be endorsement that could be put on the policy that limited certain coverage. So you're seeing some of that, but we've seen other carriers, even midterm, send out specific exclusions related to COVID. And so you're seeing that going more and more as we move forward on liability. So I'm not sure, if we're going to see that continued trend. I would imagine we were, because some of these are the major carriers, and I'm not going to call them out on this call at this point, but it is happening. So, there's always a need to blame somebody, it seems like, and insurance has become the funding for a lot of these situations. So expect, even with the advent of what's happening in the governmental backstops that are going to drive costs for business interruption, I think you're going to continue to see price pressure in and around the GL policies, because they're going to have to defend claims even if they deem to be frivolous or not without fact. You're going to see an uptick in claims as we go through. It's a little early. There are some, as I mentioned, the Walmarts and Costco and a few others that have popped in, some against the cruise line industries, but I think you'll see more and more as we go forward.
All right, thank you. And then to close us out on this slide, Reed, can you provide some commentary on developments related to management liability claims?
Yeah, there's been a lot of these tend to get a lot of press and the things that went on, because early on I think we all saw what was happening with the cruise line industries, and the boats were floating around and the people were getting sick and they were on site. So the first D&O suits that came out were against the big major cruise lines that are publicly traded. We have subsequently seen a couple of others that have come through, and there's anybody that has a requirement or has had a major stock drop that's related to it, you can pretty much expect to have some type of lawsuit come around. The pricing for D&O and management liability was already going up, and capacity being severely restricted for public liability. And what's happened also, they need the money, and the IPO marketplace is all but dried up for the management liability, especially around things that may be necessary or have any exposure to a market fluctuation. And it's not like the liability necessarily where you may have claims brought against you by third parties. This is about a business that could have implications due to CV-19 that have not been disclosed. Well, how did we even know that this was going to happen? And now that it's happened, we've had stock drops. Why didn't you warn? Proper notification. Again, I'm sounding like I'm attacking the plaintiff bar a lot, but the plaintiff bar is set up to watch, and a lot of their triggers on when claims are filed are triggered and generated by watching the public stock and watching the price drops, and those naturally trigger lawsuits in order to create, if they can find the lead plaintiff, to go after them. So we're starting to see that happen, and this is going to drive a lot of expense into the business, and carriers just simply not wanting, if they see that the business, as you go through renewal and when you're starting to show revenue implications and what's happened, and you can point to it and you say, yes, well, this is part of the COVID, especially hospitality related businesses, REITs that have a lot of exposure toward tenants, for instance, REITs that maybe are retail terms we look at. Now all of a sudden I have tenants not paying my rent. Well, what did you do to protect against it? It's going to change those issues and drive lawsuits. As it relates to employment practices, which is the other part that I think you'll see, we're concerned, and we started to see claims because of work environments that people are starting to stress. I mentioned the ones, even though we've talked about liability, the EEO is redefining certain things even as we speak regarding environmental work issues, your work from home requirements, things that employers may have to do to support the work from home in a different way. How do you track overtime for the exempt and non-exempt employees that are now eligible, that you're working more hours? How do you manage that when they normally had some type of way to conclude, or are you demanding it? So those are all issues that are coming up in questions that as you go through renewals in the coming months, or if you haven't already, that you'll start to see that how are you managing that employee exposure that has come out of this change of your working environment.
We're all struggling with those questions. Let's move to our second polling question. Have you had claims reported related to COVID-19? One is yes, a fair amount. The second option, yes, not many. The third is no. And the fourth is not applicable or used for Johnson Lambert employees. Again, please remember to press submit. Second polling question, have you had claims reported related to COVID-19? We'll give it just another second and then we'll move into the results. All right, let's go ahead and show the results. No claims reported yet. It seems to be the overwhelming answer with 56.6%. John, how do you see claim costs trending, and which products and industries are you seeing increases in claims, and where do you expect only a minor impact?
Yeah, certainly, it's first quarter statutory statements are certainly been in, and we're looking at those, and it's a little early in a process to really see what the results are driven by COVID-related. I think you'll see more of that certainly in second quarter. But, I think certainly there's been much press about the decline in auto miles driven, which, of course, has had an impact on auto accidents and auto, whether it be commercial or personal auto. So indeed, and we've seen companies come back with giving premium rebates and credits, some for a few months' time. Others, I believe Geico went out a whole year, the remainder of this year. So with the premise being that the offset that the value of the less driving, the better experience is worth certainly the rollback. I mean, it's the improvement in loss ratio certainly benefits from the decline in miles driven. Work comp payroll is going to be down. I think claims, though, to a lot of stuff Reed just mentioned a few minutes ago, I think the claims costs will be higher going forward because of some of the changes in just in general about the whole new environment, and certainly litigation costs will be up. I mean, they were up anyway in certain classes of business, certainly medical professional, certainly the whole GL segment, and so we certainly that'll continue to rise from our view. So. As the public companies have come out with their first quarter earnings and talking about second quarter, they've all made some provisions for increases in costs. And like it or not, in a lot of spaces, I mean, there'll be perfectly legitimate cases, and others that'll be a very high cost to defend for companies. But again, they'll be involved in having to settle these claims, whether they pay loss on them ultimately or not. And unfortunately for the companies, it's going to be against a smaller top line too. So there's pressure on top line because premiums might shrink a bit, and we expect them to shrink a bit, and certainly claims costs will be up. And I listened to Warren Buffett's annual meeting a couple of Saturdays ago, and he basically, in essence, there's going to be a lot of litigation going forward, and of course that results in higher costs. So.
Definitely. And if we move into the legislative impact and new mandates, Reed, earlier we discussed business interruption developments. And what about legislative developments, for example, related to premium deferrals and refunds in California? Now, just last week we saw it occur also in New Jersey.
Well, let's start with the fact that anytime there are legislative implications, it's typically going to drive cost into a program because they're trying to broaden a lot of things, especially when it's coming from the states that tend to be a little bit more liberal and more employee-oriented versus employer-oriented. And I mentioned that, we talked about California and New Jersey, and John mentioned as well, and then just today, the Pennsylvania had some of the same rulings that came out as well. The issues that come from that I don't the hidden issue, and I'm curious to see what John's going to say about this as well, from the deferrals and the forbearance and the extensions of cancellations or the inability to cancel a policy even for non-payment is creating a credit risk in the industry that I don't think is being fully vetted, and both on and for people in my situation, agents and brokers that that are responsible for payments and programs that we have on our account currents that we do on behalf of our clients to our trust accounts, as well as the carriers themselves. Carriers need money to pay these claims, and a lot of the issues that have come across, and we deal in corporate and commercial business. We do have a personal lines operation, and a lot of these things have been more targeted at the personal lines industry. And for individuals versus fleet type exposures, when the auto rate rollbacks and the things that have gone on that you've heard from State Farm and US AAA and some of the others that really don't do much commercial business. And to me, that's a little bit of a political play to create some goodwill and drive some different voting things in some of the states as well. But the workers' compensation issues, I believe, may be the most impactful as they go through, because you're going to lose what has been a common defense under occupational disease defense, which is normal illnesses of life, and it's phrased differently in different types of states, but effectively meaning that people that get colds and flus and different types of things that could have been exposed to at work or could have been exposed somewhere else, no longer will have that defense. They're going to be presumed to have gotten it at work. That's big when you start thinking about people that now have to go out on indemnity and the different way the payments flow through, and it has been a market that has, while it had been performing compared to the other lines very well, it was starting to see some erosion because of increased cost and some other things. So those are going to be issues that I think are really, really challenging. And any time in any way you look at any of the PREA that we talked about earlier, or any state that has rolled through or started to discuss a business interruption type solution or way to get money into it, they all talk about it will be paid for through additional taxes or assessments, which means you're going to have the insured, the policyholder is going to pay more, whether it's a direct premium or some type of premium tax is going to have to go to fund this. So I know it's in today's world, I use the analogy, and I think I saw Jaws on the other day, when you see from underwater and you see legs hanging down, people are underwater trying to grab legs to stay above water. I get that, but what's the fine line and what's the balance? And we'll talk a little bit later. I know there's a question that comes up regarding the cost and the reinsurance costs and some of the things, but I think what people need to remember, and I'll mention this again later, is the insurance marketplace. The insurance companies are capital markets. They require investment in their business in order to continue to offer the coverages that we all need, especially in the commercial marketplace. It's not driven by mutuals like the individual insurance companies are. Now, for personal lines, they need stock purchase. They need people to invest. And if you can't measure or give some type of predictive return, it's going to be hard for people to want to put money into that business. And those are, that to me is a very big fundamental issue that gets lost in a lot of the discussion around whether or not this is a covered event or it's not a covered event, and what the implications are.
Yeah, maybe just to follow a little bit. Yeah, I was just going to comment on Reed kind of had a bit of a question in there for me, or a comment. Certainly we're looking at liquidity, Reed, as you see this forbearance going on and this a slower collections and the receivables growing on behalf of companies, and certainly that's where the companies with the better liquidity situations will be the ones at the end of the day that can kind of carry that load as these credit risks might increase in the short term as we've gone through this crisis. So.
And I guess both of you, could you comment on the idea of government-supported pandemic policies? I know, Reed, you mentioned a little bit about that earlier, or some of the ideas that are being floated around. This would be similar to what the government did after the attacks of 9/11.
Yeah, that was the PRIA, the Pandemic Risk Insurance Act, that has been introduced, and will probably get. I sense that will get a lot of support because it's a future looking. It's not dealing with what has already happened, and future events in which that they can create some type of future funding, much like TRIA. TRIA gives you a responsibility and a requirement for carriers to do certain things, but it's not a truly funded program at this time. It talks about how it will be funded through some of the different acts, and while there's money out there to do it, but it does cap and limit everybody's exposure. That'll happen. I don't see it. But what the concern is, and I think we've already seen this as well, about reformatting, enforcing contractual term changes into the definition of business interruption. I think you may have seen that the first push through the Senate was kicked back because of the constitutional issues and questions that come up. It doesn't surprise me. We've got a Republican-controlled Senate. You got a lot of pressure in the House, which is more Democratic controlled, that it will continue to push. And again, I'm not trying to make this a political debate, but I think we can go on Fox or CNN and see what's going on as it relates to just how this whole thing's being played out. So it's going to be, there will be, but whatever comes out, if they do it, there's going to be a lot of challenges, both legally and cost, that get driven into the system that somebody is going to have to pay.
Yeah, we've been following that, and we see what's been proposed so far, and looking for a combined situation, much like ultimately came in together after 9/11. After certainly a lot of debate back then, and there'll be more debate now. But I guess the point that the industry is making, though, is that the risk is a lot different. Terrorism is a heck of a lot different risk than the pandemic. It's right. Industry is concerned about the size of the slice of pie that they have to take on, and their ability to diversify it. Terrorism is in that certainly it's more modelable now than it was 20 years ago, thankfully. But you can spread your risk better if you take some terrorism risk in one market, then you're apt not to take it maybe in another market. Whereas pandemic isn't as contained certainly as or hopefully as contained as terrorism might be. Security has improved in the 20 years since then. So major terror targets have better security and more enhanced. I mean, there's more known about the terrorism now than about the pandemic. It's just it's obviously more wide-ranging, and it's Wall Street to Main Street, and there's no modeling. And certainly the property casualty companies give a lot of credence to modeling, and the random state we're at right now, from what we know today, it's something that the industry is just concerned with what their cost will be and whatever solution gets devised. And obviously there will be a solution.
All right, let's move to our third polling question. I jumped the gun on moving the slide, so it's already up. Are you revising or revisiting your policy term? First option is yes, significantly. Second, yes, a little. And third, no. Fourth is not applicable or for Johnson Lambert employees. Again, this is our third polling question. Please remember to submit your responses, and if you need to get CPE or CRE credit, you must answer a minimum of 3 polling questions to receive credit. So again, are you revising or revisiting your policy term? All right, and we'll go ahead and show the results. No revisions. So, Reed, what are you seeing in your clients' policy changes?
And Kim, I'm assuming we're talking about insurance policies, or are you talking about operational internal risk management policies?
The insurance policy term.
I think, I believe most are trying to figure out, and we are getting more and more questions regarding availability and creation of policy terms and wording that may help in the future navigate around this or what may come through. I believe most of the policy changes are going to be dictated by the insurance marketplace than they are from the carrier's desire to change or restrict any coverages. I do believe that there'll because of pricing issues, we're seeing, carriers, some of our clients looking at retaining more risk instead of paying it in the form of premium. So there's a couple of different ways to look at that. But those are, there's not an open request to change policy terms. It's just more of how do we navigate what policy conditions and terms and conditions are being pushed on by the insurance companies.
Yeah, I think the industry.
John, are you seeing? Mm-hmm.
Yeah, I'm sorry to jump in. I think the industry agreed. I guess it's what the industry needs or what the economy needs and how the industry reacts to it, much like they do after any crisis. Of course, there'll be a shortfall in coverage or immediately, but the industry has to react to that shortfall in terms of, policies to in a post-COVID society to cover the new way that business will be run, or the comp will be different because they might have more work from home going forward. Auto may be different, so on and so forth. So I think, intuitively you're going to see some change. Business will harden. You need better tighter terms and conditions, certainly. And if that whole argument over BI goes the wrong way, certainly it's going to keep anyone else from wanting to get involved in that space, because now again you're arguing about contract certainty, which is certainly something that the industry has to depend upon. So, but yeah, it'll be a hardened market going forward.
All right, thank you, John. We mentioned the lack of reliability of the models, and I guess what are you seeing from the consensus on the scale of reinsurance claims and just your view on the reinsurance market? Yeah,
again, I'll go back to our outlooks for sectors, and before pre and post COVID, we were stable on reinsurance segment. We see our global reinsurance team sees the segment's underwriting risks from COVID-19 manageable at this time. To a large extent, it's going to be over the duration of the pandemic, how long it lasts for, and reinsurance contracts generally contain exclusions for losses that result from contagious disease or pandemics and actions of civil and military authorities. So, again, the language is assumed that it will hold up in terms of reinsurers as well. Certainly, the sector's very well capitalized. There's an ongoing alignment between the reinsurers and third-party capital, which we expect will continue, maybe to a lesser extent. But the possibility that a new flow of third-party capital may come together as the economy stabilizes. But again, that remains to be seen. We need a more stable economy for that to happen. I think it's going to be a great discipline. Go ahead. And one last thing, I think there's a great discipline to generate underwriting profit from reinsurers. So I think this is the hard market that a lot of those carriers have been looking for a while now. So.
Reed, do you think there's going to be an increase in the use of alternative risk vehicles to access the reinsurance market?
I think when you're asking that question, you're directing it mostly at captives and the clients that have captives or looking to form captives. And I believe they will, because it's going to be a direct correlation. A lot of these coverage issues that we're talking about around COVID and the pandemics are not necessarily going to be voluntarily offered by the traditional markets and how we go through a retail marketplace. But the alternative vehicle in that direct access for reinsurance purposes is something that has always been for the high or hard to place or non-available insurance, and you can construct certain aspects with using bonds or using some other structures or even accessing those markets. And John mentioned this when the property market was heavily, when it was in a softening period, was heavily driven by hedge funds. Can you create a big enough return to get other people to come in through some of the offshore facilities to participate in their risk buying treaties that are not regulated by the U.S. insurance marketplace and are not needed to be rated? I believe there will be, and we're already starting to see a lot of discussion and questions about how do we put some of these expenses into an alternative structure, i.e. a captive. And that's being looked at. I think the challenge you're going to have on that is the pricing. If you're looking for, your premium deductibility or things that you run through a captive will be difficult, more difficult to price because there's just simply not something there. But I do think for pure coverage requests or some ways to establish a rainy day fund, it will be something that will be looked at heavily and probably executed on.
Yeah, we were talking about captives, speaking about captives reacting the other day with this read, and certainly, whether it be in the 80s, with the liability crisis, and then a couple of med-mal shortfalls, I guess, when large carriers left the industry, and in 90s and the early 2000s, you see the formation of captives, group captives, and what have you. So this would seem to be a prime footing for them because of the flexibility and the ease of formation. But again, there's still that unknown about what the future will bring. But it is certainly an alternative for, as usual, for captives to respond to difficult risks. So.
Yeah, and I think the same way, going back into your legislative question, a lot of our clients have used their captive for their terrorism or their pre-funding or terrorism to access the reinsurance market directly for terrorism. So that may create the same opportunity as well.
Yeah.
And before we fit in our final polling question, let's talk through the short and long-term impacts on the industry. I guess, John and Reed, do you want to offer your thoughts on the impacts?
John, I'll let you go first.
Yeah, I think it's, a lot remains in how long this lasts, obviously, and it's going to, shorter or longer term, whether, of course, the vaccine solution, how quickly business gets back to something close to normal. I think the pressure on what we do, the pressure is going to be on the segments, on the industry to, they could be writing, likely the top line's going to be down, how they handle their expenses, how operating performance, which is one of our key measures of a company's insurance rating, how that continues going, given all the changes. Again, capitalization is pretty solid for the PC sector. I think the focus is going to be on performance, and the focus on performance is going to be good because of the changes and some of the unknowns and the litigation and certainly the run up in costs. So if you have more costs and a lower premium base, certainly that puts pressure on your returns and put pressure on your combined ratio. And again, as Reed very, very wisely mentioned a few minutes ago, certainly many of the companies in the commercial sector are public companies, so they're managing for a few different reasons, and they have to, it's not as cut and dry for them as it might be for the mutuals or reciprocals or what have you that don't have that obligation to their shareholders.
Yeah, from on the renewals and things that are going on, and when you mentioned my biography, I do a lot of work in the real estate and hospitality, and anybody that has big real estate portfolios and heavy property portfolios, a lot of them are trying to get their renewals done before hurricane season, so we're going through a lot of those right now. And so I would tell you that we've seen a heightening and an increase in pressure around a lot of these industries, especially the hospitality industry too. If you looked at Q1 results from the carriers, and even going back into last year when we started to see this market hardening and things get more difficult, I would tell you that every carrier call I'm on, and I'm on quite a few with some of the executives, first quarter was phenomenal. They were giddy with some of their results and things that are going on, which tend to start, as a retail broker, you start to say, okay, we're going to start to see this thing to flatten out in the pretty near future. Well, this gave another push into it. Now all of a sudden the exposures are getting cut significantly, payroll, sales, revenues, vehicles being shuttered or whatever it may be. So, but they still need their premium volumes because of, as we just talked about, being a stock company and things that they get measured. And by the way, some of these claims that they have reserved are under reserved, and they're coming forward, and they still need to have premium. So we've seen where guidance with some major carriers has changed, where we've actually seen now that we've gotten more renewals between April 1 and June 1 in hand, you're seeing things that may have been 5 to 10% increases, now 10 to 15. You're seeing contraction in limits being offered, especially in the high excess limit area, the umbrella. You're seeing a lot of things go up. You're seeing workers' comp that was mostly a flat type predicted renewal tick up to 2 to 5%, just simply because payrolls have been cut 35%. So they still need some of that volume because, inside even a workers' compensation, a lot of the costs there are taxes, assessment fees, and other things that go on, or reinsurance charges. It's not just what the retail carrier can consume. It's not fun, honestly, and I shared this with somebody the other day, presenting a 30% rate increase to a client that is not operating right now. Insurance companies, I'm not sure that there's a disconnect in the empathy side of the business, but they still have to run their business. And there are risks in certain classes of business that they, especially, I keep hammering on the hospitality and the restaurants, especially the smaller ones, that some of the carriers that have been dominant in that place suspended writing any new business in that marketplace because they're not sure what's going to happen. So there have been a lot of restrictions, and when they're not there, that just drives competition to a smaller bucket, which drives up price. So we are seeing pricing increase even more than what I think was predicted at the beginning of the year, especially around property. Makes sense. You got the business interruption issue and the high excess umbrella, and then in the D&O space are probably the three largest, most volatile from a pricing structure right now, and seem to be the hardest to deal with.
Thank you for the comments. And now let's quickly get in our last polling question. Do you believe the pandemic will have a significant long-term impact on the insurance industry? 1, yes, significant. 2, yes, minor impact. 3, no impact. And 4, not applicable or Johnson Lambert employee. Again, this is our fourth and final polling question. Please press submit for your response. And again, you need to submit at least 3 responses to get a CPE or CRE certificate. All right. Again, do you believe the pandemic will have a significant long-term impact on the insurance industry? And let's move to the results. Yes, significant impact. John and Reed, let's talk through these results and the PR concerns for insurance companies.
They have a significant PR concern right now.
Yeah. You don't like making evening news if you're in the insurance industry, and unfortunately it's been on the evening news quite a bit the past couple of weeks. So.
Yeah. And, I believe that the capital structure of the insurance marketplace is there's a significant risk to attract new capital to come into with the unknowns around the legislation, the magnitude, the inability to do certain things, and inability to measure loss. I will tell you that cost is going to go up in this space and continue to go up for a while. Some will argue that it was needed or necessary based on just what happened with, as John mentioned, with social inflation and the cost of litigation and the things that have happened. But it's a challenge, and I think if I could get this group that's on this call, and I know there's a significant number of people, you have to remember, always remember that the insurance marketplace is a capital market. It is a finite world. It is not something that you buy a policy and just expect that it's going to go on and on and on. When I mention capital market, it's just like putting your money in anything else. People want a return on it, and if they can't get it, then it's going to contract, which creates a significant supply problem. And we tend to forget that sometimes as to what the real underlying part of the business is.
Yeah, just quickly, I think there's going to be a lot of changes, certainly, in product and how product's delivered, and it's going to be interesting to follow. And certainly, it's something that we as analysts will be staying on top of.
John and Reed have given us some great information. Thank you very much. And thank you, everyone, for your participation in the webcast. We do have an upcoming webinar, Decoding Regulatory Mindset on Internal Controls and COVID-19 Impacts. There's a link in the Resource Center for you to register. And if you need the CPE CRE credit, please access your certificate by clicking the certificate icon. I believe it's at the bottom of your screen. Thank you, everybody.